America's employment landscape is unraveling far more quickly than most people want to acknowledge. Over the past few months alone, businesses across the United States have revealed plans to eliminate more than 1.1 million positions. That level of job loss hasn't been seen since the fallout of the Great Recession. Whole teams and divisions are being wiped off the organizational chart as if they never existed. Paychecks tied to roles earning anywhere from $70,000 to $180,000 a year are disappearing almost instantly. Even professionals with decades of hard-earned experience are being let go through impersonal, automated emails that offer no explanation or humanity. From massive tech companies to sprawling logistics powerhouses, employers are cutting staff aggressively in an effort to cope with rising expenses, weaker consumer demand, and a crushing cost of living crisis. What's unfolding right now isn't a temporary dip or mild correction. This is shaping up to be the most significant wave of corporate downsizing the modern American workforce has ever faced. And it's still in its early stages. Number 10. Walmart. For generations, Walmart has been the fallback option for American families when money gets tight. It's long been the store people turn to when paychecks don't stretch far enough, where groceries cost less, everyday necessities feel attainable, and budgets can be pushed just a bit further. But in 2025, even Walmart is starting to buckle under the pressure of America's worsening affordability crisis. When the company revealed plans to cut 1,500 jobs, it wasn't merely a routine reorganization. It was a warning sign that something deeper and more troubling is unfolding. The very system designed to support financially strained households is now under strain itself. These layoffs didn't hit storefront workers. They struck corporate teams, logistics planning units, and internal operations, the backbone roles responsible for coordinating shipments, managing inventory, and keeping products flowing to more than 4,600 stores nationwide. These weren't low-wage positions. Many of the eliminated roles paid between $70,000 and $130,000 a year, offering rare stability in an increasingly shaky economy. Their removal exposes the mounting stress inside Walmart's supply chain. And the reason is simple. American consumers are running out of money. Food prices have surged, squeezing households from every direction. Today, the average Walmart shopper is spending 15% to 22% more on basic groceries than they were just 3 years ago. Chicken, eggs, rice, cereal, canned goods, nearly everything costs more. A basic cart that once totaled $90 can now soar past $120 without much effort. When shoppers are forced to buy less, Walmart inevitably sells less. And Walmart sees what policymakers continue to downplay. The affordability crisis is spreading rapidly across the country. Rent keeps climbing, utility bills are higher, medical expenses are escalating. Families are being pushed into harsh, impossible financial decisions. As consumer demand narrows to only the cheapest, bare-bones essentials, Walmart's profit margins tighten. In response, the company has doubled down on automation. It has poured hundreds of millions of dollars into AI-powered inventory scanners, robotic pallet systems, automated sorting lines, and machine-assisted packing technology, all designed to reduce reliance on human labor. The 1,500 job cuts are expected to save Walmart tens of millions of dollars each year, a move executives view as unavoidable as economic conditions continue to deteriorate. For workers, however, the outcome is devastating. Many gave decades of their lives to the company, only to be replaced by algorithms, machines, and cost-cutting formulas. The impact doesn't stop with those employees. When Walmart, the retailer built to serve struggling Americans, starts cutting jobs while prices keep rising, it sends a sobering message. The affordability crisis isn't stabilizing, it's accelerating. These layoffs represent a turning point. The moment the cheap store became too expensive to run in an America that's increasingly broke. Number 9. Boeing. Boeing was once held up as the crown jewel of American engineering, a company that represented aerospace dominance, bold innovation, and highly skilled manufacturing jobs that supported middle-class families. For decades, it stood as proof that American industry could still build world-class machines and pay real wages for real expertise. But in 2025, that reputation took another serious hit. When Boeing confirmed roughly 2,500 job cuts, it wasn't a simple reshuffling of staff. It was another visible fracture in a company that's been under strain for years. These layoffs didn't target junior or entry-level positions. The cuts reached deep into the core of the organization: engineers, quality inspectors, aerospace specialists, and safety analysts. Many of these professionals earned between $85,000 and $145,000 annually. Eliminating talent at that level points to far more than routine cost trimming. Boeing is still grappling with the financial wreckage left behind by production delays, supply chain failures, and billions of dollars in penalties tied to ongoing aircraft safety crises. Over several years, the company has already swallowed more than $31 billion in cumulative losses. In 2025, the pressure intensified as new aircraft orders slowed and regulatory scrutiny tightened. Yes, defense contracts are still holding up, but commercial aviation, the heart of Boeing's business, has been bleeding money. The most alarming cuts came from areas tied directly to aircraft testing and quality assurance. Entire teams responsible for validating bolts, sensors, wiring systems, and structural components were reduced or eliminated, precisely the areas where errors can cost lives and trigger massive lawsuits. Boeing's leadership claims automation and streamlined processes will compensate for the lost manpower. But the reality is far more straightforward. The company is under extreme financial stress and is slashing payroll to save tens of millions of dollars each year. For thousands of workers, this wasn't just another layoff notice. It marked the abrupt end of careers built on engineering pride, national identity, and decades of loyalty. Many had spent most of their adult lives at Boeing, only to be told their positions were being transitioned. Severance packages offer little comfort when weighed against the scale of the company's financial troubles. And for the country as a whole, the emotional impact is heavy. When a cornerstone of American innovation cuts this deeply into its workforce, it signals trouble that goes far beyond aviation. Aerospace has long been a bellwether for economic health. Planes aren't ordered when companies fear a downturn. Airlines don't expand when demand weakens. And Boeing doesn't shed high-income engineering talent unless the foundation beneath it is starting to crack. These 2,500 job cuts aren't just corporate restructuring. They're a clear warning that America's industrial backbone is under serious strain. Number 8. General Motors. General Motors, the iconic automaker that played a central role in building America's middle class, entered 2025 staring down a harsh and uncomfortable reality. The long-promised shift to electric vehicles, once marketed as a trillion-dollar growth engine, has run headfirst into serious financial obstacles. Consumer demand for EVs has been inconsistent. Battery prices remain stubbornly expensive. Interest rates are still high, making financing harder. And unsold electric vehicles are piling up on dealer lots. Right in the middle of this turbulence, GM announced plans to cut 3,420 jobs, a painful restructuring move aimed at saving hundreds of millions of dollars while the company tries to reset its strategy. These reductions weren't limited to factory floors. GM targeted engineering groups, administrative departments, and a range of white-collar roles that directly supported its electric vehicle programs. Many of the affected employees earned between $90,000 and $160,000 a year, working on battery technology, software integration, and next-generation drivetrain systems. When a company starts eliminating highly skilled workers tied to its future products, it sends a clear message. The financial pressure has become unsustainable. Since 2021, GM has poured more than $35 billion into EV development, yet the payoff simply hasn't arrived. Sales projections have fallen far short of expectations. Dealerships are overwhelmed with unsold electric inventory, while production costs remain too high to compete with lower-priced models coming out of China. Every vehicle that sits idle on a lot drains thousands of dollars in carrying costs. At the same time, consumer finances are weakening. With auto loan delinquency rates climbing above 7.3%, many Americans are locked out of new vehicle purchases priced between $48,000 and $65,000. GM isn't responding to opportunity, it's reacting to fear. Fear that continued losses in electric vehicles could spiral into far deeper financial trouble. For longtime employees, the emotional toll has been severe. Many devoted decades to the company, believing the EV transition would secure their careers. Instead, they watch their positions vanish as automation, software consolidation, and aggressive budget cuts swept through departments once thought untouchable. GM's layoffs highlight a sobering truth. America's auto industry is slipping into a recession of its own. And when one of the nation's largest employers starts cutting thousands of skilled workers, the shockwaves won't stop at the company gates. They'll spread across states, suppliers, and the entire manufacturing ecosystem. Number 7. IBM Corporation. IBM stands as one of America's oldest and most recognizable technology giants, a company long associated with computing breakthroughs, enterprise systems, and highly skilled, knowledge-driven workforces. For decades, it symbolized stability at the top end of the tech economy. In 2025, that image took a sharp turn. IBM joined the swelling ranks of corporations cutting staff, announcing 2,700 job eliminations as part of a forceful shift toward AI-powered automation and tighter cost controls. These weren't the kinds of layoffs seen in retail or manufacturing. IBM's cuts landed squarely in highly specialized white-collar roles: cloud engineers, cybersecurity experts, data architects, and consultants. Many of these positions paid between $95,000 and $180,000 a year, placing them firmly in the upper tier of the workforce. IBM's leadership has been unusually direct about what's happening. Automation, they've admitted, is replacing human labor much faster than companies can realistically retrain their people. The firm has invested billions into generative AI tools and enterprise automation platforms that are expected to wipe out as much as 30% of internal workloads. From a financial standpoint, removing nearly 3,000 salaries saves IBM more than $250 million annually. But the message behind those savings is unsettling. It points to a rapidly shrinking demand for human workers, even in high-level digital and analytical roles once thought untouchable. The layoffs were concentrated in divisions tied to legacy technologies, areas IBM once dominated. As customers migrate to lower-cost cloud competitors and AI-assisted services, IBM's market share has eroded quickly, forcing leadership into aggressive restructuring. Slower contract cycles, weaker software demand, and rising operational expenses left the company little room to maneuver. Inside IBM, the emotional fallout has been severe. Many affected employees had spent 10, 20, even 25 years building careers there, only to be displaced by the very technologies they helped create. For an aging workforce, re-entering today's job market is especially unforgiving. Competing against younger, lower-cost, AI-native talent puts thousands at an immediate disadvantage. IBM's layoffs expose a troubling reality. A white-collar recession is taking shape. Highly educated professionals who once believed they were insulated are now subject to efficiency models that prioritize algorithms over experience. These 2,700 job cuts aren't an isolated event. They're part of a broader transformation of the American workforce, one where even elite tech careers can vanish almost overnight. Number 6. Microsoft. Microsoft's decision to eliminate 6,000 jobs in 2025 sent a jolt through the entire technology sector. This is a nearly $3 trillion company, one of the wealthiest organizations ever created. And yet, even at that scale, it chose to cut thousands of employees in a single move. That fact alone reveals how intense the financial pressure inside the tech industry has become. These layoffs didn't spare junior or expendable roles. Microsoft went straight to the top of the talent ladder. Engineers, cloud architects, cybersecurity experts, product managers, and AI researchers were all affected. Positions with annual salaries ranging from roughly $120,000 to well over $220,000. These are the professionals responsible for building and maintaining the digital infrastructure that powers the modern world. Azure cloud systems, enterprise security platforms, and software products used by millions of businesses and individuals all rely on their work. When jobs at this level disappear, it signals a restructuring happening at the highest layers of the company. The motivation behind the cuts is both straightforward and unsettling. Microsoft has spent more than $10 billion embedding artificial intelligence across its entire ecosystem, along with billions more poured into data centers, GPUs, and massive computing clusters. Operating expenses ballooned. Individual GPU farms can cost hundreds of millions of dollars, and training a single AI model iteration can run anywhere from $50 million to $100 million. Something had to give, and it wasn't executive compensation. These layoffs are part of a broader internal recalibration, but for employees, the human cost has been enormous. Many learned their fate through sudden calendar invites labeled business update, a modern corporate euphemism that now inspires dread. Plenty of those affected had spent over a decade at Microsoft, contributing to cornerstone products like Windows, Office, and Azure, only to see their careers end in a matter of minutes. The timing couldn't be worse. Interest rates remain elevated. Corporate customers are cutting back on software renewals, and enterprise contracts are taking longer to finalize. Even with roughly $88 billion in annual net income, Microsoft is shrinking its workforce to defend profit margins as the global economy slows. And beneath it all lies a harsher reality. AI is beginning to replace the very engineers who created it. Internal AI copilots can now handle testing, debugging, documentation, and even software maintenance, tasks that once required large teams of developers. These 6,000 job cuts go far beyond routine restructuring. They signal that the white-collar job market is entering a far more dangerous and uncertain phase. Number 5. Salesforce. Salesforce, the undisputed giant of cloud-based CRM and one of the most powerful software companies on the planet, stunned the tech world in 2025 when it announced 4,000 job cuts. For a business generating more than $34 billion in annual revenue, this wasn't a fight for survival. It was a deliberate move to shift leverage toward artificial intelligence while reducing the human labor behind its vast software empire. The layoffs focused on customer support teams, sales operations, cloud consulting groups, and so-called non-critical engineering roles. Many of the employees affected earned between $95,000 and $180,000 a year, and a significant portion worked remotely. Salesforce had long branded itself as the Ohana Company, a workplace built around family and belonging. In 2025, however, that family was downsized with calculated efficiency. At the heart of the decision is AI automation. Salesforce has invested billions into Einstein GPT, a system capable of writing emails, generating customer support responses, handling CRM workflows, forecasting revenue, and even analyzing customer sentiment. In practical terms, AI is now performing the work of thousands of employees at a fraction of the cost. Running these AI platforms isn't cheap, but replacing human workers allows Salesforce to save more than $300 million every year. At the same time, the company is dealing with softening demand from small and mid-sized businesses. As interest rates climb, software subscriptions are often the first expenses to get cut, especially tools priced between $25 and $300 per user each month. Renewal cycles slowed, deal sizes shrank, and the warning signs became impossible to ignore. Inside Salesforce, the emotional impact was intense. Employees who had been praised for strong performance suddenly saw their roles reclassified as non-essential. Internal Slack channels filled with disbelief, anger, and anxiety. A corporate culture once celebrated for warmth and inclusivity now felt distant, mechanical, and surgical. The consequences extend well beyond Salesforce itself. Thousands of consultants, agencies, and technology partners depend on the Salesforce ecosystem. When Salesforce contracts, an entire economic network tightens with it. These layoffs underscore a harsh reality. Even the most innovative companies are no longer growing their human workforces. They're expanding their AI capabilities instead. And in 2025, that transition is costing real people their livelihoods. Number 4. Verizon Communications, Inc. Verizon's decision to cut 15,000 jobs in 2025 wasn't merely large, it was a shockwave. This is one of the biggest telecommunications employers in the United States, serving more than 100 million customers who rely on its networks every day. And yet, even a company of this size is shrinking its workforce at levels not seen since the early 2000s. The layoffs swept across a wide range of departments. Network maintenance crews, customer service teams, retail store staff, cybersecurity units, corporate support functions, and even mid-level management were all affected. Employees earning between $55,000 and $130,000 felt the impact most sharply. Entire teams were restructured or eliminated as Verizon moved to slash payroll by hundreds of millions of dollars. The company expects these cuts to save more than $1.2 billion annually, a stark indicator of the financial stress building beneath the surface. At the heart of the problem is relentless pressure on Verizon's balance sheet. The company has poured billions into expanding 5G coverage, upgrading fiber networks, and modernizing infrastructure. A single wave of 5G deployment can cost between $8 and $10 billion per year, yet consumer demand hasn't grown fast enough to justify that level of spending. At the same time, competition is intensifying. Cable companies and lower-cost wireless carriers are steadily chipping away at Verizon's market share. Customer churn has risen as inflation squeezes household budgets, pushing people toward cheaper plans. While Verizon's premium offerings range from $65 to $90 a month, rivals are attracting customers with plans priced as low as $25 to $35. That loss of revenue forced Verizon to make aggressive internal cuts to prevent profit margins from collapsing. For employees, the emotional toll has been severe. Many had spent 15 to 25 years with the company, starting in entry-level roles and working their way into supervisory positions. Some learned their jobs were gone through brief video calls, with little warning and no sense of closure. These weren't abstract corporate roles. They were workers responsible for maintaining critical infrastructure, the people who kept America's communications running during storms, outages, and national emergencies. Overnight, many found themselves without jobs. Verizon's layoffs highlight a sobering reality. Even industries considered essential are no longer immune. When a company so deeply woven into daily American life eliminates 15,000 positions, it signals a serious and expanding economic contraction. This isn't simple cost trimming. It's a restructuring driven by anxiety about a far tougher economic road ahead. Number 3. Intel Corporation. Intel's move to eliminate 20,000 jobs in 2025 ranks among the largest corporate downsizing events the U.S. tech sector has ever seen. This isn't a failing startup or a declining retail chain. This is Intel, a company that once commanded nearly 80% of the global CPU market, now forced to cut tens of thousands of highly skilled roles just to stay afloat in an industry undergoing violent change. The layoffs reached deep into Intel's core. Chip designers, fabrication plant workers, systems architects, supply chain leaders, and R&D specialists were all affected. Many of these professionals earned between $110,000 and $190,000 a year. For decades, Intel employees believed their jobs were essentially recession-proof, protected by America's endless appetite for processors. The layoffs shattered that belief. The uncomfortable reality is that Intel is hemorrhaging money as it struggles to keep pace with rivals like TSMC and NVIDIA. The company has spent more than $25 billion building and upgrading chip manufacturing facilities across the United States, part of a strategy meant to restore semiconductor leadership to American soil. But chip fabrication is brutally expensive. A single advanced facility can cost $15 to $20 billion just to build, with billions more required to keep it running. Delays, engineering setbacks, and production yield issues caused massive cost overruns, problems Wall Street eventually lost patience with. At the same time, the rise of AI computing shifted power away from traditional CPU makers and toward GPU-focused companies. NVIDIA's market value surged past $3 trillion, while Intel's valuation fell behind companies far younger and once considered smaller players. That imbalance crushed Intel's stock price and pushed leadership to pursue what it called efficiency. In corporate terms, that meant cutting people. The emotional fallout inside Intel has been devastating. Engineers who helped design chips used in laptops, servers, satellites, and military systems suddenly found themselves jobless in a tech market already flooded with laid-off talent. For many, entire careers, 15, 20, even 30 years of work, ended with a single HR email. The damage didn't stop at Intel's doors. Suppliers and partner companies felt the impact immediately. When Intel eliminates 20,000 jobs, it doesn't just downsize, it sends shockwaves through manufacturing hubs in Arizona, Oregon, New Mexico, and Ohio. These regions depend heavily on Intel for employment, contracts, and local economic activity. Losing thousands of six-figure salaries drains billions of dollars from regional economies almost overnight. Intel's layoffs send a stark message. America's semiconductor battle is far from won. And even one of the nation's most iconic technology giants is paying an extraordinarily painful price to stay in the fight. Number 2. UPS. UPS's decision to eliminate 48,000 jobs in 2025 sent shockwaves through the American labor market. This wasn't a technology firm quietly trimming corporate overhead. This was one of the largest employers in the country erasing a workforce bigger than many U.S. cities almost overnight. When UPS cuts nearly 50,000 positions, it signals a deep shift in one of the core pillars of the U.S. economy: logistics. The layoffs spread across the entire operation: package handlers, delivery drivers, supervisors, dispatchers, warehouse staff, and even mid-level management. Many of these roles were unionized, paid between $45,000 and $95,000 a year, and came with strong benefits. These were reliable, middle-class jobs, the exact kind leaders have long promised to protect and rebuild. And yet, they disappeared. Officially, UPS points to restructuring and automation. But beneath that explanation lies a harsher reality driven by money and weakening demand. The company has invested billions in advanced automation, robotic sorting systems that can cost $250 million per facility, AI-powered scanning tools, driver-assist software, and fully automated warehouse robots. Each new system reduces the need for human workers. UPS expects these job cuts to save more than $3 billion annually, a staggering figure that underscores how aggressively people are being replaced by machines. The timing reveals deeper economic fractures. Package volumes have declined as Americans pull back on online shopping. With inflation tightening household budgets, discretionary spending has dropped sharply, draining billions from e-commerce growth. As revenue forecasts slipped, executives acted quickly to preserve margins by eliminating tens of thousands of workers. Inside UPS, the emotional toll has been overwhelming. Many employees built their lives around the expectation of stable, long-term employment. Drivers spent years mastering routes, developing customer relationships, and enduring physically demanding work, only to be displaced by automation and cost models. The impact won't stop at UPS. Local communities will feel it deeply. UPS hubs act as economic engines, supporting nearby restaurants, gas stations, small businesses, and contractors. When 48,000 jobs vanish, entire regions feel the shock. UPS's mass layoffs deliver a sobering message. Even essential industries, shipping, delivery, logistics, are no longer protected. Automation is advancing faster than anyone anticipated, and the workers who kept America moving for decades are now the ones being pushed aside. Number 1. Amazon. Amazon's 2025 layoffs, 14,000 confirmed cuts with a projected total that could reach 30,000, stand as one of the most aggressive corporate workforce reductions of the year. When the second-largest private employer in the United States starts eliminating tens of thousands of roles, it's more than a routine reorganization. It's a warning about where American work is headed. The cuts are concentrated in corporate and technical positions, including teams inside AWS, logistics planning, retail operations, advertising, and artificial intelligence development. Many of the affected employees earned between $120,000 and $210,000 a year, and some held leadership roles overseeing business units worth billions of dollars. The message coming from Amazon is unmistakable. No team, no title, and no department is immune. Behind the scenes, the company is reshaping itself at a massive scale. Amazon has poured more than $50 billion into AI, cloud infrastructure, and automated fulfillment. A single robotic fulfillment center can cost anywhere from $30 million to $500 million, and Amazon now runs dozens of them. These facilities operate with a fraction of the human workforce, replacing jobs once handled by thousands of people with machines that never rest, never get sick, and never ask for raises. At the same time, Amazon's retail business is showing signs of strain. Consumers are pulling back on non-essential purchases, and cart abandonment rates are climbing. When millions of shoppers stop buying $29 gadgets and $49 home items, Amazon's margins shrink fast. Cutting up to 30,000 salaries saves billions precisely when revenue growth is slowing. Inside the company, the emotional damage has been severe. Employees describe the layoff process as abrupt, impersonal, and clinical, often learning they were terminated at the same moment their system access was shut off. Many had spent years pushing themselves to meet Amazon's famously demanding standards, only to be dismissed without warning or ceremony. The larger concern is what Amazon's actions represent. When the company that helped define modern e-commerce and employs hundreds of thousands of Americans begins cutting corporate jobs at this scale, it signals a rapidly intensifying economic downturn and the rise of an AI-driven workforce replacing humans at unprecedented speed. These layoffs aren't just statistics. They're a preview of the emerging American economy, automated, efficiency-obsessed, and increasingly unforgiving to workers.